Thanks for having me to present tonight. As Brent mentioned, there's some interesting times, and hopefully we can have a chance to discuss them with the rest of the panel members, and hopefully everybody can get some good information for the evening. So I'm going to take you through a situation and outlook on the sector. If you've heard me present about market outlook before, you'll know that really looking at the United States as a price taker like Canada, Ontario is, in the majority of commodities, really outside of canola, Canada's a price taker in pretty much every ag commodity. Looking at the US and trying to understand what's going on in their market's really key for us, and so we'll go through that. We'll dig into the Canadian and Ontario market a bit, and then we'll do an outlook. So again, in terms of the US production base, it's cow herd. There's been a number of things I think kind of very unique over the last decade or so. It kind of started with 2012, where we had record drought, record liquidation in an extremely rapid way in the United States, and that led us into a number of years, for those of you that were around then in the industry, where prices, in particular on the stocker side of things, were record level for a sustained period. The U.S. cow herd bottomed in 2014, and then it's peaked again in about 2018. If you look at the numbers right now through 2022 summer, we're in about the fourth year of a slight contraction, as I would call it. And that slight contraction has started to bring down the amount of production, the amount of meat in the market. One of the challenges with, again, industries like cattle, where your breeding herd is also a product. If you're bringing cows through, or heifers that would normally be bred, they're coming through the market from a meat perspective quicker. It can have some pretty big changes, and I'm going to talk about that in a second, what that might mean. One of the things, again, if you've heard me talk about the U.S. market in general, is that it's been record after record for a number of years, pretty much across the meat complex. A lot of that has to do with the sheer size of the U.S. population, the U.S. focus on supplying its own market, but also the fact that the meat, and again, the grain complex as well, has really taken on an international focus. And that's been good from the perspective of drawing production into the market, but it can create a lot of volatility. If you look at pork and chicken, for example, in the last 20 years, production in the United States has risen about 50%. Beef has been about 4%. If you look at lamb or mutton, it's fallen actually over that same time period. In 2021, beef production was up just a little bit. The COVID years have been, as you know very well, interesting from a variety of different perspectives, and that, the fact that beef production was up, despite the fact that we saw some other challenges, was quite interesting. 2022, we're very near to the end of the year, obviously. It's looking like meat production in the U.S. would be pretty much flat compared to last year. And then they're expecting a decline of roughly 6% into 2023. And that expected decline is driving a lot of things in the market right now when it comes to the meat industry and the hog industry as well, if you were to talk about them. And there's a lot of variability in things that can affect that. I'm going to kind of go through that. One of those things is U.S. exports. So the U.S. again has refocused itself to both supply its domestic market, be a major player in that, not lose market share, but also to be able to achieve greater market share in other countries. They've done that in a variety of different ways. They've got more free trade agreements with countries like South Korea. They're trying to get back into the CPTPP, which Canada is part of. The U.S. was originally part of before Donald Trump. They're trying to get into other markets quite significantly, and in particular China. And so again, across the ag complex, despite the challenges that the U.S. and some other countries, Canada included, have had with China, we've continued to be a pretty large trading partner with them. What the U.S. has seen through 2022 is a fairly large drop in their exports to China. Some of that's due to the competitiveness of U.S. beef. Some of that's due to the fact that China has rebounded a bit from its issues with ASF in the hog industry, so it doesn't need that complementary protein. But more importantly, I think it has to do with the way the U.S. and China have interacted, and the fact that China is such a major purchaser as a government or as industry. Again, it is a much different model dealing with China just because of the sheer volume that their individual buyers acquire compared to other countries, and even compared to the United States. And so when they move in or out of a market, it can have major impacts. And that, I think, is going to continue driving a lot of the market and the volatility that we see over the next year and a half or so. And again, you can apply the same concept to hogs. You can apply the same concept to corn and soybeans as well. One of the major overarching factors that the U.S. is facing right now is drought, or dry weather and dry conditions. And again, drought is a bit of a relevant term, obviously. And given where we're at, just the start of the winter, we're not quite into the winter yet, technically, but there's a number of key things at play. Number one is that about 70% of their major grain growing areas is at some level of drought right now. They're talking in the plains in the United States that their winter wheat acreage and the potential for winter wheat strength come spring is pretty limited. They're talking some pretty significant numbers in terms of winter wheat reduction or potential, lost acres as the spring comes around. That can have a major impact in terms of moving product into, or moving acres into other product, spring grains, barley, soybeans in particular in some of those regions. The other aspect is that a lot of the grazing areas in the United States, cattle areas, are also affected by drought right now, 59%. A month ago, when I would have done the same presentation, say, for example, at the BFO's advisor meeting back at the Delta and Guelph, that number was at about 69%. So they have gotten some moisture in some areas. Obviously, this is a time of year where you do get moisture. How that plays into the spring is really going to be a big challenge for the U.S. And that is going to continue to drive volatility in the market as we go through. And it's, again, going to affect, I think, all of the sectors, in particular, the grain sector, and that's going to feed through into the feeding industries. So in terms of demand, and the Canadian market, really, that's kind of where it starts, I think, for us. The video earlier around corn-fed beef, I think, is a good example of where, we've done a really good job in the sector in Ontario, across Canada, at bringing the consumer more aware of what it is to buy Canadian, whether it's in beef, pork, and vegetables, etc. That, coupled with the fact that the total demand in the Canadian market is growing because of our population growth. Meat demand is growing. Within that, if you dig into it in more detail, lean protein growing quite significantly. Again, if you've heard me present this is kind of an old point, but it's an important one, and that is that the chicken, over the last number of years, has really been the only meat that's seen sustained per capita increases. So again, meat demand is really a function of two things: how many mouths do you have to feed, and how much is any one individual consuming? And so oftentimes when we talk about demand, we talk about it in aggregate. That's really what we're trying to serve by the broader population of cattle, hogs, etc. But when you're starting to look at things like we do right now with high prices or prices changing, how does that affect things? Per capita is where you would sort of look at to see how relative consumption is being affected. The actual numbers, or the final numbers for 2022 in terms of consumption and or per capita, they'll be out in May. Right now, it looks like we're at about 1% up as far as beef demand goes. And so again, that's a good thing, despite some of the challenges we've seen from the price side, from the overall inflation side, and some of the challenges obviously consumers are having in terms of making decisions about where they're going to spend their retail dollar. Obviously, imports in all sectors of the Canadian economy, including agri-food, are a major part of it. Overall, across Canada, we're in a neighborhood of about 20% of our demand in the beef industry coming from international imports. In Ontario, that's about 35%, again, depending a little bit on the math. Overall, imports in 2021 had fallen across Canada, but we're up in Ontario. Again, a function of some of the distribution networks, I think, that are a little bit unique in Eastern Canada versus Western Canada. Year to date for Ontario, we're up about 1%. So about where we'd been in 21, which again was a fair bit higher number. And so it's a function of, again, that wholesale demand, where our wholesale and packing industries are moving product. And again, it does a number of things for us. One is it tells us there's been competitive pressures in terms of Ontario beef. It also tells us that demand is strong because the wholesale industry and the packing industry are having to to continue to meet that demand, and imports are the way they do that. In terms of the Ontario cow herd, we've fallen about 42% since BSE. We've risen slightly in 2020, replacement cattle up just a little bit. Again, the numbers and the declines we've seen in the Canadian context in the last few years are, in a lot of ways more, subtle or flatter, I guess, than the United States, and that has an impact on what's been going on in the industry. We've seen a bigger drop, obviously, in Western Canada last year with the drought, early sale, movement of replacement heifers, either to other parts of the country, out of the US, or into slaughter. And so, next year we might continue or start to see those numbers, and thus the calf herd drop quite a bit more. In terms of Canadian slaughter, year to date, our federal plants in Ontario are down about 1%. So, for the most part, flat, given that we've got, basically one full week technically left. It's not going to be a weekend day. I wouldn't think at Cargill, given that's Christmas Eve, but it'll be probably a fairly solid week, and then, a short week the following week. We've averaged just under 12,000 head per week in Ontario this year. Normally, we're in the neighborhood of 12 to 1,300 head a week of cattle, mostly cull cows. Coming from Quebec, we're down in the neighborhood of 200 to 300 head a week. In that regard, this year we're to about 900. At the provincial level, which again, the data is up to date as of October, total cattle slaughter, again, down about 4%, except for heifers. Heifers are up about 4%. So again, is that a tell on some of the smaller or more local areas in terms of heifer retention? Hard to say. We'll see when the numbers come out in January with StatsCan. But, for the most part, slaughter is relatively flat. Again, given the idea that, our cow herd is maybe up just a little bit, maybe a little bit more replacements around, depending on what the actual numbers are coming in from Western Canada, which I think all indications are the numbers of calves coming from Western Canada were probably, down a little bit from last year from the math that I can put together at this stage of the game. In terms of carcass weights, as everybody knows, at the Fed level, we've seen carcass weights continue to rise over time. This is again a function of strong demand, not enough hooves around effectively, and so we've seen some big increases in that. This is an interesting year from my perspective. I would have thought 2022 would have seen carcass weights continue to rise again. As of right now, they're down about 2%. Some of the data that we get through CFIA in that regard can get adjusted as the year ends and we go into the new year. So, it wouldn't surprise me if those numbers were changed a little bit, but it's certainly an indication of that we're, I think at some level try to probably get into a bit of a peak as to how large the carcasses of cattle can be in terms of at least on average. In terms of, as the video showed, our major input being corn, the basis for corn, that's basically the spread between Ontario and Chicago. Where has that been? 2020, which is still in everybody's memory, was a really unique year where we were an overall net importer, which meant we were basis plus, really added a lot of cost to the industry. 2021 saw that continue for much of the year, but then sort of weaken, get more to the export level that we normally are as the year went on. In 2022, for the most part, has seen the basis weaken to an export level over the year. Now, as of right now, basically, we're down about 4 to 5, maybe up almost 7%, depending on your math, in terms of total grain corn production for the year. Silage corn production obviously is a little bit more difficult to estimate, but a little bit less corn around could potentially see the basis for corn strengthen a little bit as we go through the 2022 crop year, which goes all the way through to next year. In terms of buying calves, we've continued to see some pretty big increases in the last month and a half or so, kind of to be expected given the nature of where it appears the Fed market is going and where some of the anticipated volumes are in the United States. If you look at a comparison of Ontario cattle to Alberta feeder cattle, knowing that we have a lot of producers who are purchasing in the West, normally, at least since 2009, we're about $37 a hundredweight higher than Alberta, again, on average over the course of the week, any given week. Since October, we've averaged about 17 over And then if you look at the 9-weight cattle, we're normally around $44 higher than Alberta. And we've averaged right around that number since October. The price has obviously jumped a lot from last year at this time, in the neighborhood of $50 to $60 a hundredweight, either for 5-weight or 9-weight cattle, depending on the situation. So obviously quite a different year this fall compared to last. That's playing into a number of things. In terms of the basis in Ontario on the feeder calf side for 5-weight, the basis had weakened since mid 2021, but has kind of come back to a more average in the last few weeks. And again, I think that's a function of some pricing opportunities, maybe looking outwards, that feedlots are seeing as good opportunities. Again, we don't see as much of that in terms of pricing and what's out there from a forward contract point of view, like we do with corn or soybeans, for example. But again, I think it's a function of some of that anticipated demand. We do see some pretty wide ranges in individual sales. Again, a function of people sort of discount some of those higher or wider range cattle. The underlying demand, again, on the fed cattle side, whether it's looking at a live weight price, again, not a lot of cattle go through the ring for slaughter in Ontario, but again, there's still some activity. It tracks pretty close with the rail grade price if you're trying to convert that either to live or to rail. But again, over the last number of weeks, we've seen basically a weakening of that basis, despite the fact that the absolute price has increased. And again, it's a function, I think, of the packing industry recognizing that you've got this strength in the futures market, but they're trying to temper that a little bit with where they've been from a pricing point of view. In terms of looking ahead, for corn and soybeans, again, we're into the crop year. The crop year in corn and beans in 2021 was an interesting one because there was a lot of people that, due to forward contracting, left a fair number of dollars on the table relative to where the cash markets were. That, I think, actually kept the price of feed down a little bit in Ontario from an elevator point of view, because they weren't necessarily pricing at what would have been the spot market that we sort of track more regularly. But if you look at the crop we're dealing with now for corn, it should average out, I'm guessing, in the neighborhood of $8 a bushel over the course of the year, and down a little bit in 2023. Again, that's the crop that would be planted next spring and then sold over the year into 2024. On the bean side, 2022, again, getting close to $19 again, depending on when and how often and how much people forward contracted, that could even be above that number, which would be up about 13%. And then again, 2023 crop probably flat, if not down just a little bit. So, for the most part at these price levels, even if they're down 5 to 10%, in terms of feeding cattle and the opportunity cost there, you're still feeding some pretty high numbers. If you've heard me present before, I normally look at the November crop report from the United States, take the futures market a couple days later. Normally that's November 11th. And then you use a 5-year average basis out over the next year to kind of give a flavor of where I think things are going to go. These two graphs represent that for the remainder of this year and all of next year. So again, kind of a peak towards the summer, which would kind of be normal, a bit of a flattening and a little bit of a dip as the crop, the calf crop, comes off in the fall. But again, some pretty high prices. Will we really see calves, 5-weight calves, at $3? There's probably still going to be some, I'm going to guess. I'm going to guess that still means a wide range around that, like I've mentioned before. But that again, I think, is going to be tempered with a number of things in terms of where corn prices go over the next year. And again, I think that'll be one of the challenges, is if the U.S. drought continues, that's going to push corn prices higher, and it's likely to put pressure on that red line and try to bring that line back down. And we'll see that probably reflected a weaker basis on the feeder side throughout Ontario. In terms of the fed cattle side of things, again, continued strength, a little bit different because you do, again, have more forward contracting opportunities through packers, at least in terms of what they're offering and when they're offering delivery for and that kind of thing. And so it isn't quite as clear as it is with grain, but it does give you some indications. And we do hear numbers around 350 or so out into the middle of towards the fall for next year in some examples. And I think that's a reflection of where futures are in a 5-year basis, and because generally that gets you close. Again, we start to see some issues in the United States, continued drought, more drought in cattle regions, more heifers coming into the feeding market. That can put pressure downwards on that red line as you go out over the year. Corn prices can do the same. It depends a lot on some of these conditions. All that to say is that there's going to be volatility because the market is really tight on both ends of this. We're tight in terms of stockers, we're tight in terms of corn, and the market's going to have to play out that sort of agronomic challenge as the year goes by. What does that mean in terms of the feeding margin? Again, through the remainder of this year into 2023, again, on an opportunity cost basis. So this is what we would use for RMP, the cost of purchasing feed, purchasing soy meal concentrate. You're over $850 a head taking a 9 weight to a 1500 weight. Again, there's a lot of cattle going heavier than 15, but that's the weight we use for RMP. Strength in feeder futures through the summer and fall are going to continue to pressure that along again, and we'll see where that goes in terms of auction, that kind of thing. And those are the types of adjustments that I think, again, the volatility in the market can drive more volatility into those auction markets as the summer and as the spring and then the fall approaches. So in terms of the financial situation, again, the complicated thing about dealing with the feedlot side of things is you're really dealing with a small number of farms. Like, this is data from the agricultural census below. Again, feedlot is a bit of a challenging definition, how to define a farm. But the math there is in the neighborhood of 250 to 275 feedlots in Ontario. Obviously, as you guys are well aware in the sector, profit margins are extremely tight, debt levels are high, but it is the majority of cattle, the majority of the risk that the sector is dealing with is focused in this group of farms. And so if you look at where basically interest rates are going, operating interest having increased again this week, probably, likely to maybe go up a little bit more between now and then probably flatten for the rest of the year. That's at least about $30 a head by my math over the course of a feeding period as we go through the year. Couple that with a number of other things, including some of the declining reference margins people would have, say, for agri-stability, and it's going to continue to financially pressure the sector. So, we followed the U.S. sector. We've seen some pretty strong prices in near memory. Those prices are starting to come back a little bit. The U.S. is going to continue to contract. It may contract faster than we thought. In the short term, quicker contraction in beef means more beef in the market, which can then have some really crazy impacts in terms of volatility. And that's going to drive a lot of how the Ontario basis operates.